Financial markets are feeling the Trump effect as today, Donald Trump is officially sworn in as the 47th president of the United States. Following his election victory, the stock market surged, with the S&P 500 up nearly 5% in the following month. You had individual stocks like Tesla surge nearly 40% in the following week, and now up around 70% overall. In my personal stock portfolio, that increase in Tesla price increased my net worth by over $36,000. And my dividend growth stock portfolio has seen continued gains as well since the election. You had Bitcoin increase over 50%, crossing $100,000. There is an undeniable real impact on the market. Not only are all the top American CEOs at the inauguration, but you have crazy financial news this week around the launch of a Trump meme coin. That's right, a meme coin. That is not a joke. And Trump has had some NFTs and kind of like crypto merch in the past, but he had never had a meme coin, and this thing took off. The gamblers went all crazy with this one. You can see the coin shot up massively in the following days and has since sold off slightly. But for context, the market cap of this coin is now just under $10 billion. That makes it the 19th most valuable cryptocurrency. And you might say, does this thing have any intrinsic value? No, it does not. Not at all. In fact, they say clearly it is not an investment opportunity, investment contract, or security of any type. It is basically just a form of legalized gambling. And although it may seem a little scammy, I don't think there's anything illegal that has taken place so far. There hasn't been any rug pull where they're selling out from under. But people are just putting money and gambling on an idea, a meme. And the main reason why I'm bringing this up today is to highlight that the Trump effect is a real phenomena on financial markets. Something made up with no real value is valued at over $10 billion. And this impact carries over to more legitimate financial markets like the stock market. The Trump effect is trillions of dollars of value. So in today's video, I'm going to share the top 5 stocks that will benefit from a Trump presidency. I'll explain the logic behind my picks and even do a brief stock analysis. At a minimum, these are stocks you should keep your eye on. But let's take a step back and look at the big picture. You should not let the mania of the Trump effect impact your investing strategy. You must stay rational and based in economic reality. And when it comes to investing in stocks, there are fundamental financial principles you need to follow. First, you need to remember that these are actual businesses with real earnings and dividend payments behind them. It is not just a stock price which moves up and down. And when it comes to the stock market, it's the free market and the productivity of all these individual businesses which ultimately drive the real value. And there will always be opportunities to invest in both Republican and Democratic administrations. And that's because there will be businesses driving real productivity increases in the world. That said, a president's policies does have real impact on the economy and individual businesses. For example, if Trump were expecting continued low corporate taxes and increased deregulation in many sectors, and these things can help boost corporate profits, and over the long term, the stock price reflects the earning power of a business. So an increase in earnings is likely to drive up a stock price, and it is also likely to fuel increases to the dividends that they pay you. All right, so let's analyze the top 5 stocks to watch in a Trump presidency. That will include one high growth manufacturer that I think you guys likely know, 2 big tech companies with a lot of legal problems, but very high free cash flow and new dividend payments, a high dividend yield and high growth energy company, and another high dividend growth industrial company. And I just want to remind everyone to be civil and respectful in the comments, because I know that politics can get people emotional and highly agitated. But let's try and stay rational. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using the best stock research tool for dividend investors, which is available at dividenddata.com. Here you can analyze and find better dividend stocks and track your progress towards financial freedom. We currently have a 7-day free trial, which will only be available for a limited time, so get it now if you're interested in trying out dividenddata.com. This is only available using the link in the description and pinned comment of the video. That said, let's jump into the analysis. So So first off, before I get into stock number one, I want to explain kind of the philosophy through which I'll be analyzing these companies. I'm not going to be buying a company specifically because I think it will have this tailwind of positive Trump policies, especially if that has not been a very good business. My number one rule is that a good business is still a good business, and that a bad business will likely still be a bad business, even if they have some minor help from a Trump policy. So you might say, what are you kind of talking about there, Zach? I'll give you a couple examples of what I would consider bad investments that may benefit from a Trump policy. So first off, I have the Ford Motor Company. This is a low margin, no growth business. The company's free cash flow has only declined over the years. Revenue has been flat since 2009. It's extremely difficult to get a good return in these kinds of companies. That said, Ford will likely benefit a lot from Trump policies. For example, lower taxes for manufacturing in the US, increased tariffs on foreign cars made in Mexico or Chinese electric vehicles, and a big de-emphasis on the transition to electric, of which is not helping Ford in the short term. Basically what happens there is Ford is trading one of their profitable gas cars for an unprofitable electric car. They don't make money on their electric cars yet. Another example of a bad investment which may benefit from a Trump presidency would be US Steel. He kind of saved this company in the first term by putting tariffs on Chinese steel. But even with that, this is not a great business. Earnings have been flat for decades. It's really hard to get a good return from buying and holding a stock over the long term if the company doesn't grow at all. All right, so those are some examples of bad businesses, but let's get to my list of 5 stocks to watch. First, not that surprising, Tesla. Now, I do think this price has gotten quite a bit ahead of itself since the election. I want to see earnings per share and free cash flow start hitting record highs, which I think they might in the end of 2025 and early 2026, and I think there is a huge runway for growth beyond that. This is a company that has grown revenue at a 10-year compound annual growth rate of 39.10%. That is slowing down lately, but they're about to hit their next wave of growth. They're expecting 20 to 30% vehicle growth in 2025, and Tesla will benefit from increased incentives and lower taxes for US manufacturing, since all of Tesla cars sold in the US are made in the US. And in the same way that Trump's tariffs will help companies like Ford, they will also help companies like Tesla build their position in the United States. But the biggest impact here will be around regulation. If you're investing in Tesla stock, the only way the current valuation makes sense is if self-driving comes at scale in the United States in the next few years. And they were already planning to launch in California and Texas in 2025. But Elon's relationship with Trump has led to the possibility of federal approval for autonomous vehicles. And from a technology standpoint, it's getting very close to ready to roll, and it's improving rapidly month by month. Waymo already has self-driving taxis out in the market, and they're gaining a lot of market share away from Uber and Lyft. And frankly, the economics of self-driving taxis will be far better. So a possible federal approval of self-driving in the Trump administration would be a game changer for Tesla. So if you're investing in Tesla, that is the bull case under a Trump presidency, and that is something that I think is likely to happen in the next 4 years. Now, on the cautious side with Tesla stock, they have seen a massive run up, and the valuation is very high based on their current earnings. And you could definitely make the argument that this is a company which has been caught up in the mania of the Trump effect. But Tesla is a real, actual quality business, and they are operating in multiple high growth segments that are set to continue growing for decades. They are also inventing entirely new markets like self-driving and self-driving taxis, and the even longer long-term potential of things like the Tesla bot. Tesla is one of the leaders in artificial intelligence, and I have no doubt they're going to have massive long-term growth. So even with a high valuation, there is potential that over 5 to 10 years, this is a company which can grow into that valuation and then continue growing that valuation. That said, I am not buying Tesla at the current share price, but I am holding my position. This is an incredibly volatile company, and I only buy it when it's at a deep discount. You can see that my cost per share is $97.06. So based on the stock price, it may not be a good time to buy, but I think the real asset and business of Tesla is set to grow a lot under Trump's second term. Oh, and I forgot to mention this, but Trump has mentioned that he's going to remove credits for electric vehicles and clean energy projects. A lot of those came from the Inflation Reduction Act. So logically, people say that will hurt Tesla. But what Musk and others have said is that it will actually be far more devastating for Tesla's competitors than itself. And over the long term, that might actually give Tesla an even more dominant position in electric vehicles. And the reason why is that Tesla is actually profitable regardless of these credits. And they actually are free cash flow positive, even while they're investing billions of dollars into new AI data centers to train their self-driving AI. Tesla also is super focused on lowering the costs of their vehicles, which will help with demand. So Tesla cars are actually becoming quite affordable, and that cost will be going down over time. Whereas you have other electric vehicle companies like Rivian, which are losing money on every car they sell, and their cars are more expensive. And this is one of the better off electric vehicle companies. There are many other smaller ones that are likely going to go out of business. All right, and then stock number 2 I have is Alphabet, ticker symbol GOOGL. If you don't know, Alphabet is the parent company of Google, and this is one of the most high quality big tech companies in the world. As you can see, their earnings per share have just exploded, and they recently hit all-time highs once again. And they actually don't even trade at that expensive of a multiple. They currently have a 25p ratio based on their trailing 12 months earnings, and they're expected to have double-digit earnings per share growth each of the next few years. This is a new dividend payer as well, and one of the newer additions to my long-term dividend growth stock portfolio. The core business of Google is strong, and they are one of the leaders in artificial intelligence. The main risk with Google stock has actually been from the government. There are ongoing lawsuits and cases in the US where Google is being accused of being a monopoly. These antitrust suits are a big risk as there is a possibility the company could be broken up. However, Trump recently has been meeting with the CEO of Google as well as one of the Google founders, and he seems to have changed his tune and does not support the breakup of Google. In fact, he has actually been making statements that he wants to defend US tech companies abroad from threats of overregulation by bodies like the European Union. And that is a real threat impacting all of big tech. And Alphabet's one of those businesses where I think if the government just gets out of the way, they are set to increase shareholder value massively over the coming decade. Their only risk is around disruption of Google's search from AI. But I personally think that risk has been slightly overstated, especially since Google is a leader in AI and will likely just integrate those answers at a low cost into Google search. And they are also using AI internally to increase the value of their advertising business and their recommendation algorithms in products like YouTube. So there is a lot of room for Alphabet to grow over the long term. And the financials are fantastic. Revenue per share has grown at a 10-year compound annual growth rate of 18.41%. Free cash flow per share has grown at a 20.55% 10-year CAGR. This is a business with $93 billion of cash and short-term investments and negative $66 billion of net debt. Alphabet is a big tech powerhouse, and it's not so much that Trump is going to help them, but he's not going to hurt them. And there are real technological growth waves happening right now. In a similar manner, at stock number 3, I have Meta Platforms, ticker symbol META. This is a company which just hit all-time highs in earnings per share. They are projected to have very high earnings growth in the coming years, also a leader in artificial intelligence, and they have 2 extremely dominant social media platforms in both Facebook and Instagram. So similar to Alphabet, I think they're set to grow massively with AI. It also does not hurt at all that Zuckerberg is getting on Trump's good side. He's changed their content moderation platform, and he's kind of had his own political journey over the past few years, and if you want to say maybe he's gotten red-pilled a little bit. So Meta is a founder-led business with a dominant position. Revenue per share has been growing at a 32.48% 10-year compound annual growth rate. Free cash flow per share has grown at a 31% 10-year compound annual growth rate, $70.9 billion in cash and short-term investments, negative $21 billion of net debt. Similar to Alphabet, this is a new dividend payer, and I expect this to be a dividend growth stock moving into the future. Meta is a great business, and again, my theme is that a great business will continue to be a great business under the Trump administration. And for stock number 4, I'm going to highlight the energy sector. And in my personal dividend growth portfolio, I do own ExxonMobil. It's one of my best performers, but I am not going to say ExxonMobil here. And the reason why is that the profits of oil and gas producers like ExxonMobil depend significantly on the commodity price of oil. As you can see, their earnings fluctuate significantly over time with big booms and crashes, and their profitability is completely dependent on the price of oil at any time, and that price is determined based on global supply and demand. Now, from a demand front, the nice thing with the Trump presidency is we're going to get more investments in infrastructure, and also gas cars will stay being a large share of the market, so that should help demand for gasoline. But what people don't account for here is that one of Trump's big policies is the whole drill baby drill thing, and he wants to increase permits and lower regulation to increase all these new drilling sites, and that will be great for for lowering the cost of energy and increasing energy abundance, but it may not be great for the profitability of oil and gas stocks. Because if we lowered the price of oil down to $50 or $40 a barrel, the margins of companies like ExxonMobil is going to go down from here. Now, they may make that up in increased volume, but I don't think I would take the risk of buying this kind of energy stock at these highs. I would play the energy sector in a little bit of a different way for the Trump administration, maybe through pipelines. For example, we have this company MPLX. This is a high yield dividend stock with a 7.48% dividend yield. They've been growing the dividend at a 10.34% 10-year compound annual growth rate. The most recent dividend increase was 12.5%. So this is a high growth, high yield dividend stock, and I'm thinking about adding it to my portfolio pretty soon. And this is a company which focuses on the transportation, storage, and distribution of crude oil and gas. So compared to a company like ExxonMobil, they're less directly impacted to commodity prices. And the reason is they make money through transportation, storage, and distribution. They charge pipeline transportation fees, terminaling fees, and storage fees. And I know for sure there's going to be high volume of oil and gas and possibly increasing volumes of oil and gas. I just don't know what those prices will be. They also earn rental income from leasing out storage tanks, terminals, and other infrastructure to third parties. And they do sell some products like natural gas liquids. So I would say that pipeline stocks like MPLX are a safer way to play the energy sector compared to something like ExxonMobil under a second Trump presidency. Another interesting one I have had my eye on for a while is TPL, or Texas Pacific Land Corporation. This is an energy stock, but they actually just own the rights to a bunch of land, and they get a royalty for all the oil and gas that's generated. So what I love about this is it's extremely high margin. They have 92% gross margins and 64% net margins. The company is a free cash flow machine, and they have a great balance sheet with incredibly low net debt. So this is another attractive opportunity to invest in the energy sector that's less directly impacted from the commodity price of oil and gas. That said, I personally plan to continue holding my ExxonMobil investment as I got it at a great price, and I have a very high dividend yield on my cost basis. So this is one of those I'm planning to hold forever, but I don't think it's necessarily a good time to buy right now. And then for stock number 5, I have Snap-on Incorporated, ticker symbol SNA. This is an industrial company with a focus on tools and equipment. They have had fantastic growth in earnings per share coming out of 2010, and that has led to a great return in terms of stock price and a fantastic high growth dividend payment. The 10-year compound annual growth rate of the dividend is 14.98%. The current dividend yield is 2.46%, and it's a very sustainable payment. The payout ratio based on free cash flow is 33%, and it's 35% based on net income. So this is a very sustainable, high-growth dividend payment. Now, Snap-on, I think, will benefit from a Trump presidency because they're primarily a U.S. business, and they have the bulk of their products actually manufactured in the United States. So this is a company that could potentially benefit from tariffs on foreign products, plus incentives for U.S. manufacturers, lower taxes, and lower regulations. This is a great dividend growth stock, which I have my eye on in case there is ever a dip, and it's a stock I have saved on my watch list. So those are 5 stocks I think will benefit from a Trump presidency. You should definitely keep your eyes on those and the broader trends behind them. But remember, this is just my opinion, and you should do your own research before making any investing decisions. In general, I think we should all keep learning and trying to stay rational no matter what ends up happening in politics. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to try out the tool I used throughout the video, it's available at dividenddata.com. We currently have a limited time offer of a 7-day free trial. This is only available using the link in the description and pinned comment of the video, so click there if you want to try it out. With that said, thanks for watching, and I'll see you in the next video.